welcome to the deep dive. Today, we're going to try to decode the world of venture capital.
Yeah, it's a mysterious one for sure.
Totally.
Yeah.
So we're diving deep into venture capital and the finance of innovation.
That's right. We're going to unpack, all the complex stuff, try to get into the minds of these venture capitalists and see how they come up with those crazy valuations.
Yeah, those multi-million-dollar valuations. How do they even... It's kind of mind-boggling. But you've gone through a ton of research on this.
I have lots of notes.
So let's cut through all the jargon, all the technical terms. For someone completely new to this world, someone just dipping their toes in, what's venture capital really? What's the simplest way to explain it?
Imagine it's like high-stakes gambling, but instead of casinos and poker chips, we're talking about funding those big, groundbreaking ideas. You're hoping to find the next Google or Amazon.
Okay, so it's about fueling innovation, right?
Okay,
Taking those big swings.
Exactly. It's the rocket fuel for startups with, massive growth potential, but it's not like your typical loan from a bank. This is a whole different ballgame. It's this, this is an intricate dance between investors looking for, astronomical returns. And these passionate entrepreneurs chasing their dreams.
Okay, I like that analogy, this intricate dance. So, in this high-stakes waltz, who are the main players? Who are we talking about in the venture capital world?
Picture this. You've got your VC firms, right? They're like the rock stars of the industry. They've got the big names, the track records. Think Coldplay.
Okay, got it. The Coldplays of the VC world.
Huh.
So what would be their albums in this scenario?
Good one. So each VC firm, they manage a bunch of venture capital funds. Those are like the albums. These funds, they're basically big pools of money from different investors, pension funds, endowments, you name it, even, wealthy individuals.
Wait, so my retirement savings could be funding the next big tech unicorn.
You got it. Pension funds are actually huge in VC. Almost half the committed capital comes from them.
Wow. I had no idea my 401k was indirectly chasing those billion-dollar exits. That's wild. But what about the people within these VC firms? I always picture those, stereotypical Silicon Valley types.
Yeah, there's some truth to that for sure. But it's a lot more diverse than you might think. Oh, yeah. Think of the individuals as the band members, right?
Right.
Each person brings something unique to the table. Finance gurus, tech wizards, industry veterans. You got your drummer, your bassist, your lead guitarist.
So it's this diverse group of experts, all with that shared goal of finding and backing the next big thing.
Exactly. Their success depends on spotting those hidden gems, nurturing them and guiding them toward that profitable exit, whether it's an IPO or getting acquired.
Okay, so we've got our band, the albums, the band members. But let's talk money. How do these VC firms actually make money? And what's in it for those investors, the ones trusting them with millions?
This is where it gets really interesting. Venture capital returns, they're not your typical stock market gains. We're talking about aiming for 10, 20 times the initial investment or more.
Wow, that's a whole different level. No wonder it's called venture capital. But what motivates VCs to take such huge risks?
2 words. Carried interest.
Carried interest. That doesn't tell me much.
It's like their secret sauce. It's what drives them to hunt down those massive returns.
Okay, so break it down for me.
So on top of their management fees, VCs get a percentage of the profits when a company they backed makes a successful exit. We're talking maybe 20%, sometimes even more.
So it's a powerful incentive to find those companies that don't just succeed, but really skyrocket in value.
Exactly. They're looking for those unicorns, those rare startups that beat the odds.
Makes sense. But high potential rewards, that usually means big risks too, right?
Oh, absolutely. The reality is most startups fail. It's just the nature of the game.
So for every Google or Facebook, there's a graveyard of companies that didn't quite make it.
Exactly. That's why VC firms measure success in investment multiples, how much bigger the return is compared to what they put in. A 10x multiple means they made 10 times their money back, which helps balance out the losses from the ones that didn't work out.
So the stakes are incredibly high. They're under a lot of pressure to pick the winners. Let's say a VC firm loves a startup's pitch. What happens next?
That's when the term sheet comes into play. It's kind of like a prenuptial agreement, but for investors and entrepreneurs.
So before any money changes hands, they hash out all the details.
Exactly. It's basically a roadmap for the investment. It outlines everything.
Yeah.
The startup's valuation, how much ownership the investors get, how control of the company is divided, how decisions will be made.
Yeah.
Everything.
Sounds like it's time to call in the lawyers to decipher all the legal jargon.
You got that right. Term sheets can get really complex, with both sides wanting to protect their interests. And one of the big things you'll see is this concept of preferred stock.
Preferred stock. How's that different from the regular kind of stock we hear about on Wall Street?
Think of preferred stock as giving investors a VIP pass. It comes with some advantages over common stock, like if the company gets sold or, liquidated, they get their money back first.
So it's a way to reduce risk for those early investors taking a gamble on a young company.
Exactly. It's a safety net, and it also gives them more say in how the companies run. But it's a balancing act, You want to protect the investor's money, but you also don't want to stifle the entrepreneur's freedom to innovate and grow.
Right. Finding that middle ground is key. But now for the million-dollar question. Literally, how do VCs determine what a startup is actually worth? Those valuations sometimes seem like they're pulled out of thin air.
It can definitely feel that way from the outside, but behind those big numbers, there's actually a mix of, I'd say, art and science. They use different valuation methods, both absolute and relative.
Let's start with absolute valuation. What's the idea behind that?
So imagine trying to build a financial model to figure out a company's intrinsic value, what it's really worth. One common way they do this is through discounted cash flow analysis, or DCF. It's like trying to look into a crystal ball, trying to project the future cash flows of the startup.
So they're trying to predict the financial future of a company that might not even have a product yet. That's got to be tough.
Yeah, it's definitely a challenge. They estimate future earnings, and then they have to account for the time value of money, so they discount those earnings back to today's dollars, because a dollar today is worth more than a dollar tomorrow, right?
Makes sense.
Yeah.
But how do they factor in the uncertainty of a brand new company?
That's where the discount rate comes in. It basically reflects how risky the investment is. The riskier the startup, the higher the discount rate. A well-established company will have a much lower discount rate than a risky new startup.
So they're saying this startup could be worth a lot in the future, but it's a gamble, so we're adjusting the valuation. Okay, I get it. What about that other method you mentioned, relative valuation?
Right, so relative valuation is more about comparing apples to apples, or at least apples to slightly different apples. They look at similar companies, often publicly traded ones, to get an idea of how much a startup in the same industry might be worth.
So if there's a company out there that's publicly traded doing something similar, they use that as a benchmark.
Exactly. They analyze the valuations of those comparable companies, looking at their revenue, their growth rate, profitability, all of that. It's about finding those benchmarks to understand how the market values similar businesses.
Okay, that makes sense. But isn't it hard to find truly comparable companies, especially with startups doing completely new things?
Yeah, for sure. That's one of the limitations of relative valuation. It's not always a perfect comparison. Plus, things like market sentiment and investor appetite, those can really throw things off too.
So it seems like valuation is more of an educated guess than an exact science.
Exactly. There's a lot of subjectivity to it, a lot of judgment calls, and, this is really just scratching the surface of the venture capital world.
It sounds like there's way more to this than just throwing money at a cool idea and hoping for the best. It's a whole complex world of, risk, valuations, decision-making. But is this just a Silicon Valley thing? Or is venture capital, spreading its wings beyond the U.S.?
Oh, that's a great question. Silicon Valley is definitely still a major player, but yeah, the VC world is becoming more and more global. You see these exciting startup scenes popping up everywhere.
So Silicon Valley is not the only game in town anymore. What are some of these, VC hotspots we should be paying attention to?
Well, China, for one. Their tech scene is booming, huge domestic market. They've become a real force in VC. I mean, we're talking billions of dollars flowing into companies in e-commerce, fintech, AI, all the big stuff.
Yeah, you can't deny the impact of those Chinese tech giants like Alibaba, Tencent. They've really made a global impact.
For sure. And it's not just China. India's got a ton of VC activity too. Their startup culture is incredible. Really young, tech-savvy population. And, of course, you can't forget Europe. Strong research institutions, more and more successful startups coming out of there all the time.
It's amazing to see how venture capital is, fueling innovation all over the world. But going global, that's going to come with a whole new set of challenges, right?
Right.
Different regulations, different cultures, different ways of doing business.
Absolutely. Navigating that landscape, it requires a deep understanding of the local markets, regulations, business practices. It's not easy. That's where you see a lot of VC firms building global teams, bringing in people with different backgrounds and perspectives.
So cross-cultural expertise is becoming as important as financial smarts in VC.
I'd say so, yeah. But let's zoom back in on the investment process itself. You mentioned earlier that VCs use all these different methods to evaluate potential investments. Can you walk us through some of those tools and techniques?
Sure. One really important concept is the cost of capital. Basically, it's the minimum return an investor expects to make on an investment, given how risky it is.
So it's like a price tag on risk. Yeah, you could say that. A really risky startup, it's going to demand a much higher cost of capital than, say, a well-established, stable company. And this cost of capital, it's a key ingredient in those valuation models we were talking about earlier.
Makes sense. Investors want to be rewarded for taking on more risk. But how do they figure out the right cost of capital for a specific investment? Like, how do they put an actual number on it?
Well, there are a few different models, but one that's used a lot is the capital asset pricing model, or CAPM.
CAPM. Okay, that rings a bell from my finance classes, but I'll be honest, I could use a refresher.
Right, so CAPM, it basically links the expected return on an investment to its systematic risk. And that risk is measured by something called beta.
Beta, that's how volatile stock is, right? How much it goes up and down compared to the market overall.
Exactly. A beta of 1 means the investment tends to move in the same direction as the market. Higher beta, higher risk, but also potentially higher returns. Lower beta, lower risk, but maybe not as exciting returns.
Okay, got it. So CAPM takes this beta, throws in some other things like the risk-free rate of return and the market risk premium, and then spits out the expected return, which helps figure out the cost of capital.
Exactly. And that cost of capital, that number, is super important for figuring out what a potential investment is worth, especially in the high-stakes world of VC.
Okay, so that clears up CAPM a bit. Now let's circle back to those valuation methods. You've talked about absolute and relative valuation. Can we break those down a little more?
Yeah.
Starting with absolute valuation.
Sure. So absolute valuation, it's kind of like trying to build a financial model to figure out the intrinsic value of a company, what it's really worth all on its own. One common way to do that is through discounted cash flow analysis, or DCF, which we talked about a bit earlier.
Right, where they try to project those future cash flows and then discount them back to today's dollars. But how do they actually apply that to startups that, might not even be making any money yet?
That's where it gets really tricky. A lot of times, VCs will divide a startup's life into different stages: early stage, growth stage, mature stage. Each one has different assumptions and growth rates. They're basically trying to forecast how the company might perform over time.
So it's like they're drawing a map of the company's financial journey from the very beginning to like maybe someday when it's a big profitable business.
Exactly. And they use this map, this forecast, to come up with a terminal value, which is basically what they think the company will be worth at the end of that projected period. And then that terminal value gets factored into the overall valuation.
Wow, that's a lot of projecting into the future. Seems like there's a ton of guesswork involved.
Oh, definitely. It's not a perfect science. It relies a lot on making assumptions about market size, competition, the company's ability to execute. There's a lot of judgment involved. That's why VCs also use relative valuation to kind of get a second opinion from the market.
Right, relative valuation where they look at similar companies.
Exactly. They'll look for publicly traded companies in the same industry or with a similar business model, and they'll analyze their valuations. It's all about finding those benchmarks, seeing how the market values those comparable businesses.
So it's like saying if this other company, which is kind of like this startup, is trading at, say, 20 times its revenue, then maybe the startup could be worth something similar.
Exactly. But, finding truly comparable companies, especially for startups that are doing something truly new or disruptive, that can be really, really hard. And then on top of that, market sentiment, investor appetite, all those things can really throw things off.
So valuation, it's clearly not an exact science. There are a lot of moving parts. But beyond the numbers, beyond the spreadsheets, what else are these VCs looking at when they're evaluating a potential investment? What else matters?
Well, one thing that's absolutely crucial is the company's management team. You have to look at the people. Do they have the experience, the vision, the grit to actually build a successful business?
So it's not just about the idea. It's about the people behind it. It's about betting on the jockey as much as the horse.
100%. VCs want to see passionate, experienced leaders who can get things done, who can adapt, who can inspire their teams. They're investing in people as much as they're investing in a product or service.
That makes a lot of sense. They're not just writing a check, they're putting their faith in a team.
Exactly. And speaking of the product or service, VCs also spend a lot of time thinking about the market opportunity. Is the market big enough? Is there a real demand for what the startup is offering?
So they're looking for solutions to real problems, not just some cool technology that no one really needs.
Yeah, they want to see that the startup is addressing a real pain point. And they also look at the competitive landscape. How crowded is that space? What are the barriers to entry? They want to see that the startup has a shot at becoming a leader in the market, or at least that they have some kind of edge that will allow them to compete.
So it's about finding that sweet spot. A great team, a real solution to a real problem, a big market, and a way to stand out from the crowd.
Yeah, you got it. And that's a rare combination, which is why those big successes, those billion-dollar unicorns, are such a big deal in the VC world.
It's like finding a needle in a haystack. But when you find it, it's kind of magical. I can definitely see the appeal. It's like finding that one amazing investment in a sea of maybes. But let's not forget that human element you mentioned earlier. It's not all just like spreadsheets and numbers, right?
Oh, absolutely not. Venture capital at its heart is about people. It's about these passionate entrepreneurs with these huge, audacious visions and the investors who get it, who believe in them, who are willing to take that leap.
So the real partnership then, built on shared belief, trust.
Exactly. I mean,
Yeah.
you can have the best technology in the world, a perfect business plan, but without that shared passion, that trust between the investors and the entrepreneur, it's probably not going to end well.
It's like any important relationship, right?
Yeah.
You need that strong foundation to get you through the tough times. But this whole conversation has definitely got my entrepreneurial gears turning. What advice would you give someone like me? Someone with an idea, maybe a lot of passion, but zero clue how to even start navigating this world.
Well, first thing I'd say is don't get ahead of yourself. Funding is just one piece of the puzzle. Focus on building something amazing, something people actually need and want, something that solves a real problem for a lot of people. That's your North Star.
So before you even think about pitching to investors, you need a really solid product or service, something people actually want to buy.
Exactly. And don't underestimate the power of a great team. You got to surround yourself with talented people, people who share your passion and bring different skills to the table.
It's a team effort, right? You can't build a company on your own.
No way. And while you're building your product and putting your dream team together, start connecting with potential investors. Go to industry events, those pitch competitions. Start networking with VCs who focus on your sector.
So start building those relationships early, even before you're asking for money.
Exactly. Get your name out there, practice your pitch, show them your passion, your expertise, and when you're ready to look for funding, remember to tell a good story. Don't just hit them with the numbers and charts. Let them see your vision, understand the problem you're solving, why your team is the team to do it.
So it's about painting that picture of the future, making them believe in it.
Exactly. But what if, for whatever reason, that traditional VC route just isn't panning out?
Yeah, what are the alternatives?
There are definitely other ways to go. Bootstrapping, crowdfunding, even loans. Each one has its own pluses and minuses, so do your research and figure out what works best for you, for your company.
So many different paths to explore. It's all about finding the one that's right for you. This has been incredibly insightful. Any final words of wisdom before we wrap up our deep dive into venture capital?
Just remember, the world of venture capital, it's not static. It's constantly changing. New technologies, market shifts, opportunities popping up in unexpected places. You got to stay curious, stay informed, be ready to adapt.
It's a wild ride. Thanks so much for joining us today on The Deep Dive and for demystifying this fascinating, often intimidating world.
It's been my pleasure. And hey, who knows, maybe one day you'll be the one pitching your billion-dollar idea to a room full of VCs.
A dream worth chasing. Until next time, stay curious, keep exploring, and keep diving deep.